Okay, I'm going to show you now how to account for dividends in the hands of a recipient. Now, hopefully you can all see this video. This is just a trial to see whether this Zoom function works. I'm sharing my screen via Zoom and recording at the same time. Now, let's say you're a shareholder of a company that's listed on the Australian Stock Exchange and you receive dividend income. Now, dividend income is generally assessable income according to the tax laws. So we'll put in dividend income. Okay, now the dividend income comes in two different, in some separate categories. But firstly, in order to receive dividend income from a company, the company would have had to pay tax on its taxable profits. Now, whether it's 30% or 27.5%, being a base rate entity, the tax that it's paid from that, the company will then usually distribute a dividend to you as a shareholder, depending on its policies. Now, the dividend can be a franked dividend. Basically, franked dividend means that the tax has already been paid on profits, and franked dividends usually come with a franking credit that's attached. The franking credit simply means that it's a additional amount that the company provides. That amount represents income tax that has been paid in the past by the company. Now, franking credits is also accessible to you as a shareholder, but it's what we call a refundable offset. So franking credit is a refundable offset to an individual shareholder and to a self-managed super fund shareholder. It's not refundable in the hands of a company because a company cannot claim a refund for any excess franking credits. However, the franking credits can only reduce the company's tax liability to zero. Now, I'll show you a simple exercise. Individual shareholder, company shareholder, and self-managed superannuation fund shareholder or SMSF shareholder. Now I'll maximize these things. Now let's say you as a shareholder receive $20,000 as a franked dividend. So let's just do the dollar sign to make it more readable. So $20,000 is dividends that each of these shareholders receive. Now, the franking credit, let's assume that the company tax rate is 30%, and the franking credit is based on on the 30% tax rate. So we do a simple formula: 20,000 times 0.3 divided by 0.7 gives you 8,571. Now, that franking credit is available to all its shareholders, which means your total income is the sum of those two. Okay, so you're left with a total income of $28,571. Now, we're going to make an assumption that this is the only income that each of these three shareholders receive: individual, a company, and a SMSF. Now, with an individual, there's what we call marginal tax, which means $28,000. So equals, let me just get the formula correct. This $28,000 is in excess of the tax-free threshold. So the tax-free threshold for an Australian resident individual is $18,200. So anything between $18,200 and $37,000 falls in the 19% bracket. So what we're doing here is 28,571 minus 18,200 times 19%. Then you got Medicare levy at 2%. So you have 28,571 times 2%. So your total tax is $2,542. Now, less franking credits. So 2542 is tax in your hands as an individual. It's a tax payable amount, but the franking credits is $8,571. So you're left with a net refund. So we do the total tax minus the franking credits, 8,571. You're left with a refund of $6,029. Now, bear in mind, that refund is not including any of the offsets that an individual may be entitled to. For example, you may be a senior Australian who is entitled to a senior Australian or pensioners offset. Now, in this low income category, you're also entitled to a low income offset and low and middle income offset total of about $700. So that gets taken off your tax payable, which ends you with a greater refund in your individual tax return. Now let's do a company. Now, company tax, we are assuming that this company is a base rate entity. No, sorry, let's assume that this company is a 30% tax, because I'll show you how the franking credits can offset the tax liability. So we do 28,571 times 0.3. 30% of 28,571 is 8,571. Now, less your franking credits of 8,571. Guess what? You have zero tax, because the franking credits have absorbed all of your tax liability in the company. Therefore, there's zero tax. But let's say your company tax rate is 27.5%. So let's do 0.275. Your tax payable is $7,857. Now, the franking credits is 8,571, which means the company gets a refund, correct? Well, no. According to the company tax law, any excess franking credits is non-refundable to a company. So what happens? What happens with this remaining $714? Well, we write off the tax to zero. You're left with $714, which can be used as a tax loss to offset any future years in which the company has any further income, provided that the company meets certain tests to be able to use this loss as a carry forward. Now, let's say the company has used this loss to carry forward a profit of $1,000 in its next year. So let's say the company's taxable profit's $1,000. It can use this amount, $714, to reduce its profit of $1,000. Now, then that means the company is going to pay tax only on a flat rate of 27.5% of $1,000 minus $714. Now let's go to a self-managed super fund. The same taxable income. We're assuming that each of these entities have exactly the same income and there's no other income. So SMSF tax is 15%. So times 0.15, you've got $4,285. We use the same amount of the franking credit. Now, any excess franking credits in a self-managed super fund is also refundable. So you're left with a tax refund of $4,285, but we need to take what we call a ATO supervisory levy of $259. So that is a tax payable, so equals that plus that. You're left with a overall refund in your SMSF of $4,026. Now, this is just a very simple calculation of the different tax rates and the different tax amounts of a dividend with a franking credit that's in the hands of each a different recipient. So an individual, a company, and an SMSF. Now, let's just copy this and paste it into another cell. and increase the dividend to $40,000. Now, notice the franking credits have also moved because I've used the formula there based on a 30% company tax rate. Now, what you've got there in an individual, let's say $50,000 is your dividend income. $50,000, and that's the only income that you have as a shareholder. You don't have any other sources of income. So your total income is $71,428. Now the marginal tax is different. So let me just look at this guide for the time being. So we've got an income in an individual now of $71,000. We do equals 71,000 minus 37,000 times 0.325 plus 3572. Now, you can easily access these tax tables on the internet. They're available on the tax office website, on a Google search, and you'll see all those different tax tables. So we've worked out our marginal tax. We've also got Medicare levy, 2% of 71,000. You're left with a total tax of $16,000. Now, you've got your franking credits, 21,428. Your individual tax return, you have a refund of $5,238. Now, in this case, you can also qualify for a low middle income offset of a maximum of $1,080 because your income is between $48,000 and $90,000 or something like that. So you can use $1,080. That way your refund will increase in your individual tax return. Now let's say you're a company, you've also got $50,000 dividend. Now your company's taxable income is $71,428. Now, supposing your company tax rate is 30%, you can claim your tax for your company is 21,428, less your franking credits. 21,428 means that your company pays zero tax. But supposing your company is a base rate entity, which is 27.5%, your tax is 19,642. Now we know that from the company's tax laws, a excess franking credits is not refundable. So you can only apply 19,642 as franking credits to reduce your company's tax liability to zero. Now this remaining 1,785 can be used can be used as a tax loss as a carry forward to future years, depending on whether the certain tests are being met. Now let's look at an SMSF. Now this is where your SMSF is going to benefit with a high income. You've got a $50,000 dividend, the same franking credits, total income 71,428, tax at 15%, $10,714. Now excess franking credits is refundable in a SMSF. So that means you're left with a refund of $10,714, but adding back the supervisory levy of $259 means that your net refund in the SMSF is $10,455. So you can see from these two scenarios, the higher income, the better it is for an SMSF to get a better refund, because in an individual, the higher your income is, you'll be taxed at a marginal rate. So see the movement here between the first scenario in an individual and the second scenario in an individual taxable income. So I hope this tutorial has been enlightening for you, and that that you know now how dividends are taxed in each recipient shareholder.